And finally, we will understand index long-term strategy. We will understand index long-term strategy. So we are from FinIdeas. Investment के ideas मतलब FinIdeas. We are SEBI registered investment advisor. The disclaimer is that equity investment is subject to market risk. So kindly consult your financial advisor before having any kind of investments. We are already dealing with more than 75 members of exchange of NSE and BSE. We are 26th company in India to register our own algorithm at exchange, and we have trained till now more than 40,000 traders and investors for equities, derivatives, futures, and options. The mission of FinIdeas is providing transparent solution to everyone for achieving financial freedom. And the vision of FinIdeas is FinIdeas will manage wealth of rupees 6,000 crores and serve HNIs and members of exchange globally by 31st March 2023. My dear friends, we are already located in these 3 countries, India, Dubai, and USA, and in these 11 cities in India. So if you want to have any kind of local support from these cities, you can get it. During this lockdown period, we have done almost 132 webinars. Out of that, around 22,300 plus people have registered. Around 14,000 plus people have participated in these programs. Almost 39.5 crore we have added during this lockdown period only in this strategy. And around 118 crore is the AUA as of now in this strategy, what we are going to discuss now. So we want to show this slide just to share that if we can use technology in our business, it can make wonders in longer run. So whatever business you guys are having, if you can use technology over there, it can create a lot of sense in current scenario. Now let us come towards the index long-term strategy, how we can generate low risk, high return strategy. So friends, whenever we are talking about investment, we need to talk about properties also, because a lot of people are investing money in properties and they invest money in a property because of a certain reason. Because we are getting 2 kinds of confidence from property. The confidence number 1, that property can't become zero. The price may fall down, it may go up, but it can't become zero. And if we can hold it, sooner or later we get appreciation. So that is why people prefer to invest money in property, and that's a valid reason. But when we invest money in equity, we don't get that kind of confidence. If we select some wrong stock, then our money can become zero also. So that indirectly means that we are having very high risk in equity, as well as high returns are also there in equities. But our target was not to take that kind of high risk in our product. So we took 2 decisions. Decision number 1, that we are not going to trade in individual equities. That means no direct shares, no Reliance, no Tata Steel, no Suzlon, no direct shares. So if we don't trade in equities directly, where are we going to trade? So we are going to trade in indexes. What exactly the indexes are? So in India, we are having 2 prominent exchanges, BSE and NSE. The index name of Bombay Stock Exchange is Sensex. And the index name of National Stock Exchange, that is NSE, is Nifty. So what exactly the Nifty is? Nifty is the average of top 50 stocks of India. It is very important to understand. On the basis of free float market capitalization, the top 50 stocks combined together makes Nifty valuation. As of now, in those top 50 stocks, we are having Reliance, HDFC Bank, TCS. But before some time, we were having Satyam, Arcom, Yes Bank also in those 50 stocks. But as soon as the valuation of those stocks reached to 51 number, they automatically moved out and some new stocks came in. So my dear friends, it is very important to understand here that if the Nifty is the average of top 50 stocks only, so it indirectly gives us the surety that it cannot become zero. That means the valuation may come down, valuation may go up, but it can't become zero, because ultimately it is the average of top 50 stocks of India. Now the second point is that how the valuation calculates. So the valuation of Reliance before some time was around 9 lakh crore. That means the valuation of this company was around 9 lakh crore. The valuation of HDFC Bank was around 8 lakh crore. So if I total the 50 stocks, it was around 90 lakh crore, and this 90 lakh crore was equal to 12,000 index. My dear friends, it is very important to understand that if the richest company today, suppose is having the valuation of 9 lakh crore, so in future, after 5 years, 10 years, 15 years, 20 years, whoever will be the most richest company of India, it doesn't mean that it will be Reliance only, it may change. But whoever will be the most richest company of India, logically it should have the valuation above 9 crore. Yes or no? Come on. Logically, though there is no guarantee, but logically, the futuristic company that after 5 years, 10 years, 20 years, whoever will be the richest company of India, that should have the valuation above 9 lakh crore. Yes or no? Very nice, very good. So if that will be having the highest valuation above 9 lakh crore, then automatically the top 50 stocks combined will have the valuation above 90 lakh crore. And if this will be above 90 lakh crore, then automatically the index will be above 12,000. What exactly the learning is? Here the learning is that if we can hold the position, then sooner or later automatically it rises. If we can see the past data, the Nifty chart is showing that it has fallen down also, it has moved up also, but after some time it is always making new high because the 50 stocks continuously keep on changing as per the valuations. So we can see that here the index has gone up, it has fallen down, again it had made new high. Again it had fallen down, it had made new high. Again it had fallen down, it had made new high, and so on. So that indirectly means that the guarantee what we were getting from property, that it can't become zero, and if we can hold it, then sooner or later it rises. Both the surety we are getting from index of that country also. Because index is the average of top 50 stocks of India, it cannot become zero. And because it is having the direct relationship with the market valuation, so sooner or later it rises. My dear friends, I am having one question to all of you. So the question is on your screen. Have you done any kind of investment till now in equity or mutual funds? If you have done any kind of investments in equities or mutual funds, click on yes. Else click on no. So last 3 seconds, 3, 2, 1, and 0. And my dear friends, I am really very happy to share that almost all of you have done some or other kind of investments in equities and mutual funds. So that is a very nice thing. It will become very easy for you to understand this concept. So 100% people have done some or other kind of investments in equities and mutual funds. So now let us come toward the next point. The next point is that how equity plus safety can make prosperity. So for this, first we are going to buy index. So suppose the index valuation is running near to 10,000, just for an example. So we will invest 10,000 and we will get the index delivery. Simultaneously, my dear friends, simultaneously we are going to buy the protection also. Protection means put option. If we calculate the premium of past 5 years, 6 years, we will understand that it is having the valuation near to 5% a year. So that means we need to pay 500 rupee premium. So for us, the complete cost will reach to 10,500. But this 10,500 will give us the surety that because of any reason, if market falls down, then my 10,000 is going to remain protected. Yes or no, my dear friends? Yes or no, everyone. Dear friend, the more you are going to participate, the more you are going to learn. And the more you will learn, the more you are going to earn. Very nice. Very good. Very good. So ultimately, if we pay this additional premium, additionally, we are getting the surety that our money is going to remain protected. That indirectly means that suppose if I invest 1 crore rupee, then in any case, again, listen to this. In any case, during full 1 year, my value cannot go below 95 lakhs because I am completely protected. So what will be the worst case scenario over here? The worst case scenario will be that suppose in 2020 index is running at 10,000. 4 years have gone, we have reached to 2024, but index is still running at 10,000. Ultimately, this is share market, so it may happen. So if market remains at the constant level, then we are going to lose the premium, what we have paid against the protection of that portfolio every year. During the mid years in 2021, 22, 23, suppose market has gone up like last year, 10,000 to 12,000. Again, market has fallen down like this year, 12,000 to 8,000. Again, market has gone up and next year market has again fallen down. Suppose I have made the portfolio of 1 crore rupee. So that indirectly means for protection, I am going to pay 5 lakh rupee. Next year, market has gone up from 10,000 to 12,000. So that indirectly means that market has gone up by 20%. My question to all of you is, what will be the valuation of your portfolio? Come on, everyone. Market has gone up from 10,000 to 12,000. So that indirectly means that market has gone up by 20%. My question to all of you is that what will be the value of your portfolio? You have made the portfolio 1 crore at the level of 10,000. Market has reached to 12,000. So your portfolio will reach to 1.2 crore. Thank you. Ultimately, you are going to earn 15 lakhs over here because you have paid 5 lakh against premium. Again, next year, we are going to protect the portfolio of 1.2 crore. So we need to pay a little bit higher premium. Next year, market has fallen down. Market has fallen down by 33% from 12,000 to 8,000. But your portfolio will remain constant from 1.2 crore to 1.2 crore only. My dear friends, this is the beauty of this product. That when market has fallen down, your valuation has remained intact. Your portfolio must have fallen down to 80 lakhs. But the 40 lakhs, what you have incurred the loss in your portfolio, that you are going to recover from the put option what you have bought. So ultimately, your net portfolio valuation will remain constant to 1.2 crore only. And the 40 lakhs what you have got from the put option, again, you are going to buy new shares at 8,000 level. So your number of equity will automatically rise. And your portfolio valuation will remain constant. You will again pay the premium. Next year, market has gone up from 8,000 to 12,000. So market has again risen up by 50%. Your portfolio will also go up by 50% from 1.2 crore to 1.8 crore. So what exactly we have seen over here? When market is rising, you are also rising. And when market is falling down, you are not falling down. And next year, when market is recovering, you are making new highs. And why? Because you have bought the put option. That is why you are getting this additional benefit, that when market is falling down and you are not falling down, and next year when market is recovering and you are making new high, because you have bought the put option. Again, next year market has fallen down from 12 to 10, but you know that your portfolio is going to remain constant. So in 4 years, index has remained constant from 10 to 10 only. But you have made your portfolio from 1 crore to 1.8 crore. You have paid this premium 9 plus 6, 15 plus 6, 21 plus 526 lakh rupee. So ultimately, you are not going to get 1.8 crore, rather you will get 1.54 crore. But the fantastic learning is that during these 4 years, market remained constant, but you have grown. So normally, many times we feel that the put option is having the cost for us. Try to understand this is not the cost for us. This is giving us two additional benefits. Benefit number one, that when market falls down, we will not fall down. And benefit number two is that when market will recover, we will make new high. So that is why it is making sense in longer run. In 1 year, we may feel that we have lost the premium, but in 10 years, we can't feel that we have lost the premium, because we will get 2 or 3 years in such a way when market has fallen down and we have recovered the complete premium what we have paid during these years. So this was the earlier was the hypothetical example. Now let us come to the real example. In past 17 years, index has gone up by 12 times. But people who have invested money in these kind of strategy with protection, they have made 17 times money. So that means they have made good returns in longer run. Simultaneously, let us see the risk side. During these 17 years, we have witnessed index to get fell down more than by 50% a year. So we have seen the risk beyond 50% a year in index, but you have never witnessed the risk beyond 5% a year in this strategy. So that indirectly means that you have reduced the risk as well as you have enhanced your returns. So people who are saying that higher the risk is higher the return, we don't believe in that. We believe that smart calculation makes high returns. And here you have chosen two smartness. Smartness number one, always trade in index. Why? Because index never becomes zero. Sooner or later, it automatically rises. And smartness number two is always take proper protections. Protection is not the cost for us. It is indirectly like a mediclaim. We buy mediclaim. This year, nobody got ill. So we will pay that premium. Next year, again, we will lose the premium. But third year, fourth year, or fifth year, if someone from our family goes to hospital, whatever premium we have paid in last 3-4 years, we are going to recover at one shot. So the same formula is applicable over here in put option also. So whatever premium we are paying in 2-3 years, we are going to recover all the things in one shot. So indirectly, instead of making a bigger loss in one shot, we are incurring some cost so that we will not incur the bigger loss. Mr. Warren Buffett, he had made billions from few dollars in stock market, and he is summarizing his investment philosophy in just 2 lines, that there are only 2 rules of investment. Rule number 1, never lose money. Never lose money. And rule number 2, never forget rule number 1. My dear friends, try to understand this rule number 1. What exactly it is saying, that this is our own responsibility to protect our own portfolio. So if we can protect it, we can automatically grow it. So I am having one more question to all of you, my dear friends. And the next question is on your screen as of now, that do you understand the basic profile of call option and put option? If you understand the basic profile of call option and put option, click on yes. And if you don't understand anything about call option and put option, click on no. Come on, everyone. The more you guys are going to participate, the more you guys are going to learn. And the more you will learn, the more you are going to earn. So last 3 seconds, if you know anything about call option and put option, click on yes, else click on no. We are taking these kind of polls to understand that how many people want to understand basic profile of call option and put options. So last 2 seconds, 2, 1, and 0. And my dear friends, I am really very happy to share that around 38% people understands basic profile of call option and put option. And around 62 or 63% people don't know anything about call option and put options. So we are keeping all together a new series of webinar called Fundamentals of Futures and Options. There we explain what exactly the options are, what exactly the futures are, how it behaves, what are the rules and regulations, how we can use margin leverage, what exactly the mark-to-market profit and losses are, how it can make sense for us, and how we can differentiate it from speculation versus investments. So we normally keep this kind of webinar once in a month. Very soon we will declare the date of January month. So you can opt for that webinar. It can make sense for you in longer run. You will understand. That is also a completely free webinar. So now let us understand that how we can use this skill. We understood that we should invest money in index. We should buy the proper hedges. So if we want to protect ourselves as well as we want to grow, then how and what can we do? So now just take an assumption that you are having 1 crore rupee in your bank account and you want to make a portfolio of rupees 1 crore. I am taking the example over here of 1 crore rupee. That doesn't mean that you need to invest 1 crore. You can do the same investment at a lower rate also, or a lower amount also. So now suppose you are having 1 crore rupee in your bank. You want to make portfolio from 1 crore rupee. You want to invest that. You can do that kind of investment in equities, in mutual funds, in PMS, in FDs, wherever you want. So here in this example, what you are going to do? So from that 1 crore rupee, you are going to invest 30 lakhs in equity segment. And rest 70 lakhs you will put in debt. So 30 lakhs in equity segment, what exactly you are going to do? So you will buy index mutual funds or index ETFs. So buy index fund. So you have bought index fund of rupees 30 lakhs by investing these 30 lakhs. So you have got the portfolio of 30 lakhs in your account. Now you will put that 30 lakhs portfolio as a collateral and you will buy the index futures of rupees 70 lakhs. So ultimately you have made the portfolio of rupees 1 crore. Your vision was to make the portfolio of 1 crore by investing 1 crore. So just by investing 30 lakhs, you have made the portfolio of 1 crore. So if I consider the same example in properties, suppose you like one property of rupees 1 crore, you want to buy it, you have bought it. How did you buy it? You have made the payment of 30 lakhs from your bank account and you have taken 70 lakhs rupee bank loan and you have got the property of 1 crore. Now if market rises, you are going to earn on 1 crore rupee, and if market falls down, then you are going to lose on 1 crore. But we don't want to lose on 1 crore. So what will we do? We will buy immediately the protection. So if we incur the 5% cost against the protection, this 5 lakh rupee cost, this 5% cost will give me the surety that now my 100% portfolio will remain protected. Yes or no, my dear friend? Did you get this point till now? Everyone. At last, we will have the question answer round also. And I would be very happy to give you the answer of all your questions. So if you have any kind of questions, kindly stay with your questions. I will give you the answer of your questions also. So here, just by investing this 5% premium, you have got the protection that now your portfolio of rupees 1 crore will remain constant. The next cost we need to incur is the financing cost. Why financing cost, my dear friends? Because you have invested just 30 lakhs rupees, but you have made the portfolio of 1 crore. So indirectly, you have made the portfolio of 1 crore by investing 30 lakhs only. So the rest 70 lakhs will be charged. So when we buy futures, we need to pay futures forwarding cost every month. So in Nifty, we are paying around 30 points, 40 points a month. So indirectly for a year, it comes to near 500 points. So that is indirectly 5% cost a year. My dear friends, this 5% looks like a cost to us, but this is the best opportunity for us to earn money. Indirectly, in India, if we are getting the funds at 5% cost, indirectly in India, if we are getting the funds at 5% cost, so it gives us the surety that we can generate little bit more returns by putting our own money in debt. So if we are getting the funds at 5% cost, take it and put your own money in debts. So if you can generate 7% over there, RBI bond is giving 7.15 as of now. So if we can generate 7% return from that, indirectly we are going to get 2% more. Are you getting this, my dear friends? So what exactly it had made? Why we are buying these futures? We are buying these futures just because of this reason only, that when we buy futures, our cost of acquisition of that future is lower and we can put our own money somewhere else. So just by investing 3.5 lakh rupee more, that is 70 lakhs, 5% of 70 lakhs. So just by investing 3.5 lakh rupee, we are getting 70 lakh rupee for a year. So indirectly, our total cost is 8.5 lakhs rupee. But this 8.5 lakh rupee cost is giving us two confidence, two surety, two benefit. The benefit number one is that now my complete fund is protected. And the benefit number two is that till now we have invested 30 lakhs only, but we have got the portfolio of 1 crore. We are going to earn on 1 crore because we have made the portfolio of 1 crore. Rest 70 lakhs we will park in debt. If we generate just 7% or 7.15% a year, indirectly on this 70 lakhs, we are going to generate 5 lakh rupee as interest income. Yes or no? Come on. Yes or no? So the 70 lakhs rupee is going to give us the fixed income of 5 lakh rupee a year. So indirectly, my total cost or net cost will remain to 3.5 lakhs only. That is 3.5%. So what exactly the learning is? The learning is that if market falls down, then your maximum risk is 3.5% only. But if market moves up, then you are going to generate returns on full 1 crore rupee. Yes or no? Come on. Yes or no? Everyone, everyone, everyone. Thank you. So what exactly it had made? You have made the portfolio of 1 crore rupee. You are downside protected and you are generating upside good returns. Now, if we want to reduce this cost further, what exactly we can do? So if we want to reduce this cost, we can make the efficient use of this debt amount. My dear friends, we have made the investment of this debt at a 7% a year. Suppose some of you are having the loans in your account, some car loan, business loan, third party loan, any term loan, CC loan, or any other loan. And if you are paying around 9% return, 9% interest to somebody else, what you can do? Just repay your loan from this 70 lakhs. So indirectly now you are going to save interest at 9%. If you can save the interest at 9%, you are going to generate more return. The more return if you are going to generate, so your cost will automatically get reduced. I understand that this will not be applicable for everyone. If you are not having any kind of loans, then normally it becomes difficult as of now to generate 9% fixed income. But people who are having some other sources where they can generate 9% returns, they can reduce this cost further. So the next plan is called basic plan. The first plan, what we understood, that was the relax plan. Why the name of this plan is relax plan? Because after listening to this plan, we feel relaxed. The downside we are protected, upside we are going to generate returns on full amount. Whenever market will fall down, my portfolio will not fall down. But whenever market will recover next year, again I am going to make new highs. So that is why we are feeling relaxed. The second plan is called basic plan. Here again we are going to make the portfolio 1 crore by investing 30 lakhs only. So till now everything is same. But the debt amount we will use somewhere else. There we can generate 9% return. So indirectly we will generate 6.3 lakhs interest, or we will save 6.3 lakhs interest. So our net cost will be 2.2% only. So the second plan we understood was basic plan. Still we can reduce this cost further. So when I asked you that do you have any kind of investment in equities and mutual fund? So all of you have given the positive answer. So now what can we take the additional benefit of that? Here we have invested 30 lakhs rupees, my dear friends. It is very important to understand. We have invested 30 lakhs rupees. Why? Because we bought ETF and we put them as collateral. But now suppose you are already having equity or mutual fund holdings with you. Try to understand. You are already having equity or mutual fund holding with you. So what you can do? You can put that equity or mutual fund as collateral. So you don't have to invest this 30 lakhs. If you don't invest this 30 lakhs, you can park this 30 lakhs also in debt. If you park this 30 lakhs also in debt, you are going to generate more interest income. The more interest income will automatically reduce your cost. Yes or no, my dear friends? Yes or no? Everyone, everyone, everyone. So the next plan is called power booster plan. Why exactly the name of this strategy is power booster plan? This plan, because we are going to use the power of our current equity or mutual fund holdings. We can use them as a collateral so that we don't have to put money in equity market. Rather, we can put that money in debt. We can generate more interest income. So here, instead of investing 30 lakhs in index ETF, we will put the stocks or equity mutual funds as collateral. We will buy the index futures of full 1 crore now, because we wanted to make the portfolio 1 crore. So now our portfolio has become 1 crore rupee. We will earn on 1 crore. We will lose on 1 crore. We don't want to lose on 1 crore. So we will buy the protection by paying 5 lakh rupee cost. Now this time we are going to pay the financing cost on full 1 crore, because we have not invested our own money as of now. So the financing cost on 1 crore at 5% will be 5 lakh rupee. So my net cost will be, instead of 8.5 lakhs, it will be now 10 lakhs rupees. So this 10 lakh rupee is my investment. By investing this 10 lakh rupee, we have got the protection, and now this 10 lakh rupee will make the returns on 1 crore rupee. Rest 90 lakhs we will put in debt. If we generate 9% income, we are going to earn 8.1 lakh rupee as interest income. So now our cost, our net cost, our max risk is 1.9% only. Are you getting this, my dear friends? Try to understand. This is the amount that normally we pay to the PMS as financing, as advisory fee only. So that is our maximum risk in the portfolio. So we can reduce our cost by protecting our portfolio, as well as we can generate interest arbitrage, because we are getting the futures at low carry forwarding cost, while we can generate more returns from debt. So now my question to all of you is that, do you have any kind of loans with you? Do you carry any kind of loan like business loan, car loan, term loan, third party loan? So if you are having any kind of loans, click on yes. And if you don't have any kind of loans, click on no. So last 3 seconds, the more you participate, the more you are going to learn. So 3, 2, 1 and 0. And friends, I'm very happy to share that almost 60% of audience is having any kind of loans with them. So they can take the benefit of that also. Repay your loan, save your interest. That is also the income for you. So the money you save is money earned. So you can generate extra returns from this also. Now people who have done these kind of investment, what was their ultimate profile and their returns? So here, try to understand. We have taken the example of rupee 1 crore. Here we have written the dates of the last year of every year, last day of every year. So that means 31st December 2002, 2003, 2004, and so on, 31st December 2019. The index level on that day, 1100, 1800, 12,168, and so on. Investment we have made 1 crore rupee. What exactly our NLV of Nifty and NLV of this strategy? NLV means net liquidation value. That means if you exit from on the day one only, then you are going to get back full 1 crore rupee. If you exit after 1 year, and if you have invested money in Nifty only, Nifty index, then you would have made 1.7 crore. In this strategy, you would have made 1.67 crore, because we are incurring 2-3% cost. But in longer run, in 17 years, in direct investment index would have made 1 crore to 11 crore rupee. While here this strategy have made 1 crore rupee into 18.5 crore rupee. What exactly the meaning is? How we have generated these kind of returns? Because whenever markets are rising, you are also rising. But whenever markets are falling down, market has fallen down by 52%, but your max risk was 4% only. Next year, market has again recovered, but you have made altogether new highs. And that is why you are outperforming every 4 years, 5 years, or 6 years. So in last 17 years, you have never witnessed the risk beyond 4% a year, while you have generated the returns of 18.90% CAGR. So almost 19% CAGR we have generated, while we have restricted the risk to the certain limit of 3 to 4%. This is the real example of one of our customer. They have invested money from 2014. Suppose we are making both the amount of index as well as amount of investment at 100. So this 100, the blue line is showing that how the index has performed, and the red line is showing that how the customer has performed. And what we can see, that whenever markets are rising, we are also rising. But whenever markets are falling, we are not falling down in that extent. And that is why next year when market is rising, we again make the difference. Whenever markets are falling down, you are not falling down. But whenever markets are rising, you are also rising. Market has again fallen down, but you have not fallen down to that extent. Next year market has gone up and you have again gone up. What exactly the learning is? The learning is that if you can restrict the losses, you can generate extraordinary returns. So here the difference is increasing year by year. So that is called the outperformance with the low risk. On the numerical table also we can understand that we have started both Nifty and NLV at 100. Nifty has become 114, while customer has become 120. Next year, this 114 has reached to 90, but you have reached from 120 to 112 only. So when market is falling down, you are not falling down to that extent. But whenever markets are rising from 90 to 114, you are also rising from 112 to 141. Market has again fallen down 114 to 103. Your risk was 141 to 127. And next year market has gone up, you have also again gone up. During this corona time, 158 rupee has fallen down to 97 in index, while your portfolio of 187 has not gone below 171. So downside, you are remaining protected, and upside, you are generating returns. Now people may have one more question, that can we have some kind of systematic withdrawal with this kind of investment? Then yes, you can withdraw the systematic returns also year by year or month by month. So what we have witnessed the performance of 19% a year for last 17 years. So what we recommend that people can withdraw around 6% a year easily. And after that also they are going to have good performance. So for example, if you are making the portfolio 1 crore rupee, so indirectly you can withdraw 50,000 every month as a regular income. So indirectly 6 lakh rupee you are going to withdraw every year. So what exactly is going to happen? So we have again recalculated the performance. Suppose if you are investing 1 crore rupee initially, every year you are withdrawing 6 lakh rupee, that is 50,000 per month. So in 17 years, you have already withdrawn 1.02 crore against 1 crore. So now your net investment is 0 or negative. So you have already withdrawn this money and still your portfolio is having the valuation of 15 crore as of now. What exactly the learning is? The learning is that people who want to have regular income with the growth, they can also make these kind of investment from here. So now the next plan is that is this systematic withdrawal plan that we have already understood. So what exactly was the conclusion? The conclusion that suppose if you are investing 1 crore rupee, every year you can withdraw 6 lakh rupee. So till 17 years you have withdrawn 1.02 crore. Still your net liquidation value is 14.95 crore. So that indirectly means that you have earned 14.97 crores. We can compare this with FDs also. If we invest money in FDs, suppose 6% FDs are giving. So you have invested 1 crore rupee, every year you are going to withdraw 6 lakh rupee. At the maturity, you are going to get back 1 crore rupee. Here you have invested 1 crore rupee, every year you have withdrawn 6 lakh rupee. But till now, again, it is having the valuation of 14.95 crore rupee. So that is the difference between FDs and these kind of plans. So the next question we may have that what is the minimum investment? So the minimum investment in this plan is of 1 lot. That means that you can make the investment of 1 lot also. Nifty is having the lot size of 75. As of now, the index valuation is around 13,000 plus. So we are having the lot size of 10 lakh rupee. So here it is written 9 lakh by looking at the 12,000 example. So 9 lakh or 10 lakh is the minimum portfolio valuation. How much you need to invest? So we have already seen 3 plans. The relax plan where we are investing full 100% money. The basic plan where we invest 30% only and rest 70% we are using somewhere else. And the power booster plan where we are investing 30% of our equities or mutual funds that we keep as collateral. We invest only 10%. So in numerical terms, if you are making the minimum investment in relax plan, we need to invest around 9 lakh to 10 lakh. In basic plan, we need to invest around 2.7 to 3 lakhs. And in power booster plan, we can start this kind of investment by investing 1 lakh rupee only. In power booster, we will use the stocks of 2.7 to 3 lakhs. So what does it mean? It means that the middle class investor can also make these kind of investment. They can have safety in their account as well as they can generate good alpha in their investments. So now, my dear friends, what exactly the FinIdeas is going to charge? So FinIdeas charges the advisory fee. So every 6 months, if your portfolio will remain below 1 crore rupee, then the negligible fee of 75 paisa every 6 months that FinIdeas will charge. If you reach to 1 crore, then your portfolio fee will reach to 0.62 paisa. And if you reach to 5 crore, then your fee will reach to 0.5% every 6 months. So if you compare this fee with other investment avenues, in mutual funds, if we invest money through advisors, then we indirectly are paying the cost of around 1.75 to 2% a year. In PMS also, we pay around 2.5 to 3% a year. And in some PMS, we additionally pay the revenue sharing also. While here in this advisory product, your on an average cost is 1.25% a year. So we are among one of the lowest fee charging organization. So the lower the cost, the higher will be the returns. So if we compare this with equities and mutual fund investments, suppose I am having the money and I want to compare that should I invest money in equity, mutual fund or PMS, or should I invest money over here? So suppose I want to make the portfolio of 9 lakhs. So in equity mutual funds, I am going to invest 9 lakhs. Here also I will invest 9 lakhs. If market becomes double, so in equity mutual fund PMS, my 9 lakh will become 18 lakhs. Similar amount I am also going to generate over here. But if market falls down by 50%, my 9 lakh can become 4.5 lakh. But here my 9 lakh will never go below 8.7 lakh. So the investment is almost similar. Returns are almost similar, but low, but we are having the risk at a very low level. So this is the extraordinary point, what we can generate from here. So overall, if we can summarize the complete thing, in Relax plan, we are investing full 9 lakh rupee to make the portfolio of 9 lakh rupee. And we are having around 3.5% cost a year. In basic plan, we invest 30% only. So we make the investment of around 2.5 to 3 lakhs, while still we are generating the returns on full 9 lakh rupee. We are having the cost of 8.5% a year, but indirectly we are saving the interest on rest 6.5 lakh rupee because we have not invested over here. So we are going to use that amount somewhere else. So if we generate the interest income of 58,000 out of this, then indirectly we are having around 18 to 20,000 rupee cost for one lot a year. If we invest money in power booster, we need to invest only 1 lakh rupee, but still we are going to make the portfolio of 9 lakh rupee. We will have the cost of 10%, that is around 90,000 a year, but we are going to save the interest on rest 8 lakhs rupees. So indirectly our interest income will be 72,000 rupees. So our net cost will be around 18 to 20,000. So my dear friends, what exactly the learning is? We can reduce our risk and we can generate alpha returns or extraordinary returns by protecting our portfolio on a regular basis. So what exactly the overall features were? The features are that this is the combination of equity and debt. We are downside protected. So we are having limited risk downside. This is completely index-based strategy. So that is why we are having low risk strategy. We have the strong past track record. We are having online back office with us. So you can get all the reports on just click of the button on your mobile or on your laptop or PC. You can have systematic withdrawal plan also. There is no lock-in period. So that means whenever you want to enter, you can enter. Whenever you want to exit, you can exit. But still we recommend to have investment for 5 to 10 years. We have the dedicated team who can have the systematic withdrawal or systematic advisory through algorithms. People can make their retirement and higher education and kids' wedding plan through these kind of investments. And finally, my dear friend, the golden line is that all the trades are going to happen in your own account. That means you don't have to give your money to anybody else. You will keep your money in your account only. Wherever you want to trade, you can do those kind of trades. We will give you regular advisory. We will manage your positions. We will handle the reporting system. We will advise you on regular basis, but you are going to keep your money with yourself only. So it can make wonders. You will get the safety, security, as well as the confidence. People are having few questions and you can also add your question. So in last these 10 minutes, I am going to share few questions. What normally people are asking, that how will it make money? Why? Because index is giving almost 14 to 15% return a year. We are having around 9% cost a year. in this strategy. So how I am going to generate the returns? So try to understand what exactly this cost was of 9%. We have bifurcated this cost in three terms. The 5% was the hedging cost. The 3.5% was the financing cost, and around 1.25 or 1.5% was the financing cost or this FinIdeas fees. So overall around 9 to 10% you are having the cost. But try to understand this is not the cost for us. All these 3 points are generating their returns additionally in the market. How? Because the first cost is the hedging cost. This 5% cost is not the cost. Ultimately, this is the deal. What exactly the deal of protection is that I will put 5% money as a premium. If market moves up, I will lose this. But if market falls down, then I am going to earn the complete difference amount. Try to understand. If market moves up, I will pay 5% only. The rest all will be my profit. But if market falls down, then I am going to get the complete difference. So in longer run, if you check the performance, you will see that the put option cost is not the cost for us. Sooner or later, we recover it. When market moves up, we lose. When market falls down, we earn. So if we see it in a longer run, this will cover its own cost. And additionally, we are getting one more confidence from this, that whenever market is going to recover, we will earn extraordinary. So ultimately, this 5% is not the cost. This is the additional deal what we are getting, and we are getting the additional benefit from this. The second point was the financing cost. That is the direct benefit we can witness. We are paying around 5% cost while we are generating 7% from the debt. So indirectly, we are our 2% outperforming immediately from the day one. So this is not the cost. And the third point is the FinIdeas fee. By paying this fee, you should understand that you already pay this kind of fee to MF, mutual funds, equity, PMS, everywhere. Here also you are paying the cost. But by paying this cost, you are getting the different ways to cut your cost. You are getting the ways to save your tax. We try to utilize your funds efficiently. Continuously, we are giving you the reporting. We are tracking your position continuously. So by taking these kind of steps, we normally try to generate alpha returns in your portfolio. So I hope that you must have liked this idea. If you want to know further more about this, then you have already got the link on your chat box. Kindly click on this and you can do your KYC. So a KYC is the formality that we need to complete before having any kind of personal advisories. Until 31st December, we are doing this KYC process at free of cost. So you are having the opportunity as of now to complete your KYC. When you complete your KYC, you need to give your basic information as well as your proof of PAN card and your address proof so that your KYC will get it done. Once it will get it done, you will get the access to our investment portal. There you can do different kind of testings and you can understand that what kind of plan you should choose. You may have the question that why FinIdeas? So you should choose FinIdeas because we are SEBI registered investment advisor. We have the complete online back office. We are having almost 18 years plus experience in equities and mutual funds and advisory market. And we have the complete algorithmic online portal where you can generate on all the advisory with the speed, accuracy, and consistency. My dear friends, you may have the question that do we require any kind of advisor in these strategies? Yes, we require the advisors. Why? Because you will require new ideas every time. You need to understand the exchange rules. Strong research is required. Technology is required. Reporting. We will suggest you best suitable rates, how you can cut your cost, take your tax benefits. The experience is also making its own value. We will help you in the disaster management time. We are having a lot of kind of disasters in equity markets every now and then. So at that time, we can create these kind of situations into opportunity. So you can get these kind of benefits. And we are having a lot of data with us. There we can do a lot of research so that you can generate good deals in market. what exactly our clients are saying. So this is the smart work with innovative ideas. When market falls, our fund will have the limited fall. Algorithm for advising the trades we are keeping with us. People are fully satisfied with the planning and our execution. People get growth of equity market with the safety. We use technology and smartness, and our technology and smartness are unbeatable. We answer all the queries to our customers. People do not need to worry when market falls. They get protection against the fund in worse situations also. Making money in a most disciplined way. This is a great strategy. So these all were the lines from few of our customers. So now, my dear friends, if you have further questions, you can ask us. We will be happy to give you the answer of your questions. Every Thursday, 4 p.m., we are having these programs. And every Sunday, 10 a.m. like today, we are having these programs. So if you want to invite your friends and relatives or your surrounding, then you will get the message on the chat box. You can forward this message to your friends and relatives so that they can also take the benefit of these programs. We are consistent in keeping all these programs on a regular basis. So if you want to invite your friends and relatives, you will get the message on chat box, so you can invite them. Till that time, we are thankful to all our well-wishers. You have given us the continuous support. You have already always tried to motivate us, as well as you have enhanced the details of these products or these investment strategy to your friends and relatives. So thanks a lot once again. Pooja, can you send the brief message if it is possible, like the program detail with this link? It will help people to forward the complete message to their surrounding.
Yes, sir. Yes, sir.
Okay, thank you. So now, friends, the last question is on your screen. And the question is that when you take the investment decision, you put your first focus on returns or on safety. Where you put your first focus? When you take the final decision about your investment, where you put your first focus, on safety or on your returns? So last 3 seconds, 3, 2, 1, and 0. And my dear friends, I'm really very happy to share that 80% of audience is having the first focus on safety, and we also believe in this. If we can safeguard our money, we can grow it. So always, whenever you are taking the decision about investment, always see how safe the investment plan is. We may feel a lot of different kind of return strategies, but then we found normally that we have lost our principal over there. So it is very important to protect the funds first. So I'm very happy. Again, if you have any kind of questions, you can ask us. And if you like this concept, then you will get the Google link. You can give a small review to us over there. So you have already got the link over here. Kindly click on the link. Give us the rating as well as your 2 lines. We will be very happy to read your lines. And what additional benefit we are giving to people who give us the review. Whenever we are having any kind of complimentary programs, we invite all the people who have given us the reviews. So just give us the review and get the chance to attend our complimentary programs we are keeping. So friends, you have already got the message at your end on the chat. You can send this message to your friends and relatives if you want them to attend this program. If you have any kind of questions, kindly get in touch with us on WhatsApp at 93749856000. We will be happy to give you the answer over there. So once again, on behalf of FinIdeas, we are very happy and thankful to all of you. You have come over here. You have listened to us patiently and you have given your positive feedback to us. So once again, on behalf of FinIdeas, myself, CA Govind Jhamar, I am thankful to all of you. And I wish that you make use wealth, you protect use wealth, you enjoy that wealth, and finally, you give that wealth to your next generation for your next generation. So these are our wishes to all of you. Thank you. Bye-bye.